We end the week on a high, but wow, have we been riddled with AI doubts. Where has your mind been at?
Yeah, it has been a really interesting tape in recent weeks and months. I mean, the debate around AI, the return on investment around AI, around the quality of the balance sheets, the war on the model front, right, between ChatGPT and Google's Gemini. And I think moving forward, markets are realizing this is going to be less of a competition on just the innovation, although the innovation is really important, but also on balance sheets. And the show me the money, this kind of desire for markets to really see companies with AI-tied cash generation, which is a tricky environment to be in. Because if you want to see growth from AI, but cash, you might need to actually let go of some cash in the near term, right, to invest in some of these infrastructure build-outs to ultimately get the growth that we're looking for.
I mean, investors being asked to be patient. The word I've heard time and time again this week is discerning. Yeah. Is that what you feel people are starting? It's not all boats are rising. We're picking our winners already.
Exactly. It's we had 3 years of AI providing this really powerful tide, lifting a lot of boats. And this year we've seen a lot more discernment, right, amongst these names. We think that can continue. Now, it doesn't mean that AI isn't still this kind of rising tide, but we're now seeing the different markets here. The markets around models, the markets around cloud services, the markets around infrastructure. And now we want to see who are going to be the leaders, who are going to be the companies that actually capture the best economics in each of these markets. So it's not necessarily zero sum, but now competition is really ratcheting higher, and balance sheets are starting to fray a little bit, right? We're tapping into debt markets, so companies are also seeing greater differentiation amongst themselves that way. You are a cross-asset perspective. Should people be owning the debt of these big companies, corporate bonds as well as equity exposure? I mean, I guess it depends on what you're looking for. I think the Fed is lowering interest rates, and if you see interest rates move lower more broadly, like there is going to be demand for this debt issuance, and we're expecting a lot of that. There's also $500 billion in dry powder and private credit, right? So I don't doubt that this capital will find a home, but I think the question for investors is to just make sure that you have some diversification to this theme in your portfolio, because as extraordinary and transformative as AI is going to be, the last few weeks have reminded us that it's going to be choppy along the way. There can be surprises and unknowns. So you want to make sure your portfolio is built to withstand those choppier waters while still benefiting from the secular opportunity that remains. What almost has been the theme of 2025 is how dominant the private sector or private sector names have been on your maybe overexposure in your public portfolio. I think of a name like OpenAI. We think of SpaceX and its valuation. OpenAI potentially being $830 billion, just to pip the post on SpaceX's $800 billion valuation. How much are you seeing your clients wanting more exposure to the private markets, and how is that going to translate to public in 2026? It's so key, and it's such a big difference from what we saw in the internet era, right? When all of these internet startups were just going public on day one. And today you have these AI native companies reaching scale that we've never seen before in private markets. And of course, there are the big model developers. But what's been actually most interesting for me has been seeing the explosion in AI applications. If you think about who are the companies that are really at the center of end user demand, selling to consumers, selling to businesses, it's these more niche AI applications. And they are growing at scales that we've never seen before, right? The average AI startup reaching $100 million in under 12 months. On average, that's taken startups about roughly 10 years to achieve. You had Patrick McGoldrick here yesterday from our firm talking about this dynamic. So absolutely, if you want some of that growth exposure, you're going to need a look in private markets. In our long-term capital market assumptions, we actually see that the long-term return expectation in private equity at 10.2 versus large cap public equities in the US, 6.7. A big reason for that is starting valuations in public equity markets. In private markets, you have that issue too. So selectivity is going to be really, really important, but we still think there's a lot of opportunity. What about opportunities for IPOs next year and those who haven't got the private exposure getting it when it goes public? Yeah, that's going to be really interesting, because some of these companies like OpenAI and SpaceX, at their private market valuation, they would already be top 15 companies in the S&P 500. So they're not even public yet. And when they do go public, investors, we're going to see what the demand is at that time. But you're going to be getting into a company that already looks kind of like a mega cap, And I think these companies are then going to have to stand against public market scrutiny, like the scoreboard that these companies actually have to really attest to. So it'll be really interesting. I think if we get these IPOs next year, it'll be a really powerful, really like referendum on the AI ecosystem, which is an opportunity and a risk for the broader space next year.